Okay, so this video is really just a reminder about how monetary policy works and that we kind of need two different ways to be able to consider monetary policy. And that's kind of the forward thinking. If we're given a monetary policy, then we need to be able to say what that will eventually do to the economy at large. And then we also need to be able to work in reverse. We need to be able to see something happening in the economy and reverse engineer what policy would be appropriate as a response to that. So we're going to talk through both of those things kind of quickly here to kind of pull the pieces together. So the first element here is, how does monetary policy affect the economy? This is the most direct and forward-thinking way. So we can think that the Fed has four monetary policies available. And those policies are: they control the reserve ratio, how much banks have to hold in the bank. They control the discount rate, the rate at which banks borrow from the Federal Reserve itself. They control what we now call interest on excess reserves, how much the Fed pays to a bank when it is holding money that it doesn't necessarily have to hold. And they, of course, control open market operations, or the buying and selling of bonds. And so in this case, let's put all of these somewhat in the same direction. So the Fed's going to lower the reserve ratio, lower the discount rate, lower the open market, or lower the interest on excess reserves, and they are going to buy bonds. All four of those policies would be considered expansionary and would increase the money supply. And so let's demonstrate what that does here. Right? So we have a downward sloping money demand and a vertical money supply curve with an economy operating at interest rate E. And we take four policy actions, and any of those four policy actions would expand the money supply, which means they would shift the money supply to the right, to MS2. And as the money supply moves to the right to MS2, we can see on the graph that the interest rate is going to decrease to R2. So we can set up that these four policies, required reserve ratio down, discount rate down, interest on excess reserves down, and buying bonds, are all going to lead to an increase in the money supply, and the increase in the money supply is going to lead to a decrease in the nominal interest rate. And then, of course, we need to be able to carry the information on this graph and the changes to the money supply and the interest rate into our ADAS model. So in this case, we have a downward sloping aggregate demand and an upward sloping SRAS with an economy operating at PLE and YE. And as the interest rate goes down, we know that consumer and investment spending are going to increase because money is cheap and savings is now less valuable, so people are encouraged to spend their money, and businesses are going to get greater returns on their investment projects, their purchases of physical capital. So we are hoping to see increases in spending, and as spending increases, we know that aggregate demand will increase, which will shift us to the right to AD2. And as aggregate demand increases, we can see that this economy will move to Y2 and PL2, which are both increases. An increase in output, or real GDP, and an increase in the unemployment, an increase in price level. And then we can also conclude, looking at output and real GDP, we can conclude that unemployment must be decreasing. So that is the forward-thinking model of how monetary policy works and how the policies work their way into and through the economy, and what the Fed is necessarily trying to do. But we also need to be able to consider this more in reverse. In other words, what the Fed actually works its way through. And when we read Fed policy in class, when we read their press release, we saw that the Fed actually normally starts with an evaluation of the economy. So we actually start on this side. We look at AD, we look at SRAS, we look at YE and PLE, and the Fed might be deciding that in this economy, Y is low and unemployment is high. In other words, they might be determining that this economy appears to be in a recession because the output is not high enough. And so they might be saying, we want to increase output and we want to increase price level so that we can push down unemployment. Those are their goals. And now we have to kind of reverse engineer what do they need in order to get there. So if they want to increase output, we can see that the way to increase output is to increase aggregate demand. They're going to need aggregate demand to shift over to the right in order to push price level higher, push output higher, and hopefully drive employment up and unemployment down. So if they need more aggregate demand, they need an increase in spending. And now from a monetary perspective, we have to think, what's going to get people to spend more? Well, the way we are going to get people to spend more is if we can decrease interest rates, and in this case, we're talking about the nominal interest rate. And if we're going to decrease the nominal interest rate, well, let's go to our money market, right? A downward sloping money demand, a vertical money supply at RE. What do we need to do to our money supply to decrease that interest rate? We need the money supply to increase, which will drive interest rates down to R2. And so then the question becomes, what policies are going to get us that outcome? What policies are going to get output moving up? And the answer is going to be the same as before. Reserve ratio down, discount rate down, interest on excess reserves down, and buying bonds. But despite the fact that the answers are the same here, it is a different thought process. We need to be able to understand that these policies are expansionary. And so sometimes our problems and our questions are going to come, and really the way the Fed is working is they are actually going to be starting on this side of the economy and setting a goal for the economy and then working their way backwards to determine what policies are going to accomplish that goal. Or as we have it phrased up here, what's the appropriate monetary policy given the economic situation we're facing? If we needed to contract the economy, of course, we would reverse all of our monetary policies. If I needed lower price level and wanted to reduce output for any reason, then I would have to decrease aggregate demand, decrease spending, increase interest rates, decrease the money supply, and therefore reverse all of these policies back the other direction. So it seems confusing a little bit as we say it here, but we need to be comfortable enough with monetary policy to both start with our policy and work forward to the changes in aggregate demand in the economy, but also do the opposite, start with the economy and work in reverse to get ourselves back to what policy will accomplish our goals.